A standard for a product or service is a predetermined unit cost set under specified working conditions. A standard cost can have the following uses: budget preparation. Standard costs and standard sales prices are necessary for the preparation of budgets. Motivation. A standard can represent a predetermined cost for a particular period for a particular cost center. Hence, it can motivate those working within the cost center to ensure that the standard is achieved. Control. By comparing a standard cost to an actual cost, differences are highlighted and can be investigated. Performance measurement. These differences between the standard or predetermined cost and the actual cost can form the basis for assessing the performance of cost center managers. Inventory valuation. Standard costs can be used for the measurement of inventory to be included in the organization's statement of financial position and statement of profit or loss. There are four main types of standard. Basic standards. The assumption here is that nothing has changed since the standard was first set. The standards remain unchanged over long periods of time. They are used for trend analysis, to illustrate how material or labor costs, for example, have changed over time. However, as the standards remain unchanged, they usually become outdated, meaning they cannot be used to highlight efficiency levels or as a basis of performance assessment. In fact, basic standards can serve to demotivate employees, as an outdated standard can become either too easy or too difficult to achieve. Performance assessment would also be difficult given a demotivated employee. Current standards. Current standards are based on current working conditions. They assume current efficiency and cost levels would be maintained. They can be useful to apply when perhaps current working practices are not normal, and applying any other type of standard would only provide meaningless information. However, as staff are not encouraged or expected to improve on what they are currently doing, perhaps reduce costs or improve efficiencies, they may become demotivated. Productivity levels could suffer as a result, and fair assessment of performance would be difficult to achieve. Ideal standard. These standards are based on perfect working conditions. They assume an optimal level of efficiency and cost. Hence, an ideal standard might assume that machinery does not break down, employees do not become ill, or perform below their best. In reality, an ideal standard might not be possible to achieve, which can have a negative impact on employee motivation and productivity. Also, fair performance appraisal would prove difficult given an ideal standard. Attainable standard. An attainable standard assumes there will be some improvements in current efficiency and cost levels. However, the standard also assumes normal waste, idle time, and other inefficiencies will arise. Employees should feel that attainable standards are challenging yet realistic and achievable. Hence, employees should be motivated to meet the standard, and assessment of their performance should be more accurate as a result. Flexed budget. A budgetary control compares actual results to budgeted results. The difference is referred to as a variance. If the results are better than budgeted, then a favourable variance arises. If the results are worse than expected, then an adverse variance arises. A flex budget is prepared at the end of the period. It is prepared by applying standard costs and standard revenues to the actual number of units produced and sold in that period. Hence, when comparing actual performance to budgeted performance, or to the flexed budget, as the comparison is made using the same level of activity or the same number of units, then a meaningful variance analysis can be performed. Let's take a look at an example of how a flex budget might be prepared and its relevance in terms of the performance assessment process. F Company has prepared the following flexible budgets at the beginning of the financial period. Given 10,000 units of production, material costs are estimated to total 30,000. Labour costs will total 70,000 and overhead is budgeted at 20,000. Assuming F company produces 12,000 units, then material and labour costs are budgeted to total 36,000 and 84,000 respectively, while overhead remains at 20,000. At a production level of 14,000 units, material costs are forecast to be 42,000. Labour is expected to amount to 98,000, while overhead is budgeted at 20,000. The requirement is, if actual production for the period was 12,500 units, and the production costs incurred totaled 170,000, what is the meaningful total variance for performance evaluation purposes? To calculate a variance, the actual production costs will be compared to the flexed production costs. The flexed production costs, or flex budget, is calculated by applying the standard cost for material, labour and overhead to the actual number of units produced. Given the total material cost at the three separate levels of production, it can be derived that material is a variable cost, in that it increases in line with output. Hence, the material cost per unit is $3, meaning the flex material budget is $37,500, being $3 per unit multiplied by actual production of 12,500 units. Similarly, labour is a variable cost, as the increase in total labour cost is in direct proportion to the increased number of units as per the three flexible budgets. The labour cost per unit is $7, meaning a flex labour budget of 87,500, being actual units produced of 12,500 multiplied by the standard labour cost of $7. Budgeted overhead remains at 20,000 for the three levels of production. Hence, overhead is a fixed cost, meaning the same overhead amount of 20,000 can be applied to the flex budget. In total, given 12,500 units of actual output, flex production costs total 145,000. The variance is the difference between the actual cost incurred, 170,000, and the flex budget cost of 145,000. Given the higher actual cost compared to the flex budget, the difference of 25,000 can be referred to as an adverse variance. The variance should be analysed into its component parts, material, labour, overhead, and investigated as to why budgeted costs have been exceeded. The variances should then form the basis of performance assessment and future cost control. Variances are used as a basis to assess performance of the budget holder or person responsible for that budget. However, a positive or adverse variance does not necessarily mean that the budget holder has performed well or performed badly. Responsibility accounting tells us that a budget holder or a manager should only be assessed based on what they can control. Hence, we must be able to distinguish between controllable and uncontrollable factors. A controllable cost, for example, is a cost which is influenced by the budget holder. For example, a labour manager may be responsible for the cost specific to hiring and paying staff. An uncontrollable cost is a cost that cannot be changed by the budget holder. For example, an increase in the rental cost of the manufacturing plant, or a foreign exchange loss incurred as a result of changing economic conditions, would be seen by the labour manager to be an uncontrollable cost.